Good day, Iggy. For today's interview series, I'd really like to dive into JPMorgan's latest analysis on how Singapore banks and REITs are positioned in this lower interest rate environment. It's a topic I know many investors are curious about, especially with all the recent monetary policy changes.
Hey, Ivana. Good morning. Absolutely. I'm happy to discuss this crucial topic. As you know, I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth here at the Investing Iguana. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I produced over 900 videos with more than 500,000 watch hours as of June 2025. I also focus on regional and global economic trends, so this topic is right up our alley. The JPMorgan report really highlights some key shifts happening in our local market right now.
Let's start with the big picture. JPMorgan says Singapore banks will bear the brunt of lower interest rates. Can you break down what this actually means for everyday investors?
Think of it this way, Ivana. Banks are like middlemen who borrow money cheaply and lend it out at higher rates. The difference is their profit margin, called net interest margin, or NIM. When interest rates fall across the board, banks can't charge as much for loans, but they still need to pay depositors something reasonable. This squeezes their profit margins significantly. Recent data shows Singapore banks' NIMs have declined from 2.2% in 2023 to around 2.1% in 2024, with DBS maintaining a NIM of 2.11% in Q4 2024, while OCBC's NIM eased to 2.16% and UOB's to 2.03%.
That sounds concerning for bank investors, but I noticed JPMorgan still maintains a neutral stance on banks. Why aren't they more bearish?
Great question. Here's where it gets interesting. While the NEM pressure is real, Singapore banks have some unique strengths. They're generating strong fee income from wealth management services, which has been booming. Think of it like a restaurant that's making less on main courses, but more on desserts and drinks. DBS, for example, reported record net income of $303 billion in Q3 2024, with net fee and commission income jumping by 31.6% year on year to Swandong $109 billion. This kind of granular detail is something we often break down in our daily premium content, where we get a head start on these insights.
Now let's flip to the other side. JPMorgan seems quite positive about REITs in this environment. What makes them the winners here?
REITs are like the opposite of banks in this scenario. When interest rates fall, their borrowing costs decrease, which directly improves their profitability. Singapore-focused REITs are particularly well positioned because they avoid complications that overseas REITs face. Things like currency fluctuations, rising vacancies in foreign markets, and different economic conditions. Local REITs have been showing strong performance, with diversified S-REITs demonstrating resilience in their operating metrics.
That makes sense. But are all REITs benefiting equally, or are there specific types that are doing better?
Excellent point, Ivana. The performance varies significantly by REIT type and focus. Capitaland Integrated Commercial Trust achieved strong retail rental reversion of 10.4% in Q1 2025, supported by the renewal of 209.5K square feet of retail space, with portfolio occupancy stable at 96.4%. Meanwhile, Capitaland Ascensus REIT maintained portfolio occupancy of 91.5% and achieved positive portfolio rental reversion of 11%. In Q1 2025. It's like choosing quality local businesses that understand their market conditions better.
I'm curious about the MAS $5 billion equity market development program that JPMorgan mentions. How significant is this for our local market?
This is potentially a game changer, Ivana. The program was announced in February 2025, and MAS has received good response from global and regional asset managers who have submitted proposed strategies. What's particularly interesting is that MS aims to shortlist suitable strategies by the third quarter of 2025, with a focus on Singapore-based fund managers and strategies that invest fully or substantially in Singapore public equities. I shared a similar analysis with our members a few days ago, giving them a real-time perspective on this development.
Speaking of small and mid-caps, JPMorgan seems cautiously optimistic but not expecting dramatic outperformance. What's your take on this?
They're being realistic here. Small and mid-cap stocks face challenges like lower liquidity and higher multiples. However, the MAS program could provide the catalyst they need. According to UOB Kay Hyun's analysis, most selected mid-caps are trading at significant discounts to both emerging and developed market peers, with 19 small mid-caps holding net cash ranging from 6% to 73% of their market capitalization. RHB has also identified 20 small-cap stocks across construction, consumer, and industrial sectors as potential opportunities for 2025. It's like finding quality companies on sale, but you need patience for the market to recognize their value.
Let's talk about JPMorgan's specific stock picks. They mention names like Capitaland REITs, Keppel DC REIT, and others. What do you think about their selection criteria?
Their picks make a lot of sense. They're focusing on companies with strong track records of earnings growth and quality balance sheets. Take Keppel DC REIT, for example. It recently joined the Straits Times Index and delivered strong performance with distribution per unit, growing 14.2% year-on-year to 2.503 Singapore cents in Q1 2025, maintaining robust occupancy at 96.5% and achieving positive rental reversions of 7%. These are companies that can weather economic storms and benefit from structural trends like digitalization.
What about the broader economic context? JPMorgan mentions concerns about tariffs and trade deals. How does this factor into investment decisions?
This is where the analysis gets nuanced. Singapore's economic outlook has been revised, with the Ministry of Trade and Industry maintaining the 2025 GDP growth forecast at 0.0% to 2.0%. After Q1 2025 showed 3.9% year-on-year growth. While there are global uncertainties, Singapore REITs have shown resilience. The MAS has been proactive in monetary policy adjustments to support growth. It's like having an umbrella ready when storm clouds gather.
Before we wrap up, what's your personal take on how investors should position themselves given this analysis?
Here's my view, Ivana. I see this as a tale of two sectors with different risk-reward profiles. For conservative income-focused investors, quality Singapore REITs offer attractive opportunities with strong operational metrics. CICT's 10.4% retail rental reversion and Clear's 11% portfolio rental reversion demonstrate this strength. For those willing to take more risk, the small and mid-cap space could offer opportunities, especially with the MAS program providing support. Banks, while facing NEM pressure, aren't broken. They're adapting with strong fee income growth, as evidenced by DBS's 31.6% jump in fee income. I rate this environment as cautiously optimistic for quality REITs, neutral for banks with strong fee income diversification, and selectively positive for quality mid-caps.
Iggy, that was incredibly insightful. Thank you so much for breaking down this complex market dynamic with the most current data for us today. I certainly learned a lot about how different sectors are navigating these changing conditions.
My pleasure, Ivana. It's always great to discuss these crucial market developments with the latest information. For those who want to really stay ahead and get my daily insights, sometimes even before they're generally available, that's what our premium members enjoy for just about the cost of a coffee each month. It's truly a valuable resource for consistent market information and analysis.
Absolutely. Thank you, Iggy, for providing your insightful analysis with the most up-to-date information on this important topic. I look forward to our next video podcast together.